Over the past several years, market leadership has narrowed, passive flows have concentrated capital into a small group of mega cap names, and much of the broader market has been left behind. But underneath that concentration, there's a very different story. One of dispersion, mispricing, and a much wider opportunity set. And for active managers willing to do the work, the US small and mid-cap universe offers one of the deepest hunting grounds in global equities. Today, we're going to explore that opportunity. I'm joined by Aman Budhwar, portfolio manager of the US Small and Mid-Cap Equity Fund here at Pender. He joined Pender in 2022 and has over 25 years of experience in equity research, analysis, and stock picking. Throughout his career, he's taken a long-term bottom-up approach focused on identifying durable businesses with sustainable competitive advantages, strong returns on capital, and the ability to compound over time.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, penderfund.com/disclaimer.
Aman, it's great to have you here and welcome to the Pender podcast.
Thanks, Laura, and thanks for the opportunity. I am as excited as you are, though it's hard to be more excited than you right now.
Sounds good. All right, so how about we start from the beginning and talk about how you think about investing. How would you describe your investment philosophy today?
Yeah, like you said, I've been in the investment business for over 25 years, and most of my work has been concentrated in either the US markets or global markets. And through that period, I've honed on the investment philosophy that I followed for all these years, and it has paid rich dividends both in markets that have been going up as well as markets that have taken a step back. And I think it's centered around three key tenets. The first is look for companies or businesses that have a sustainable competitive advantage. The way we kind of identify that just on a one metric is companies that have a return on capital above their cost of capital. So that clearly represents the fact that they have been able to maintain that the business strength over time, even though they've probably been earning above their cost of capital, but they have kept competition at bay by some kind of sustainable competitive advantage that they would have over time. The second tenet we look for is companies or businesses in growth industries. So as long-term investors, we want to stay invested for the long term. And in order to do that, we look for companies that are able to compound earnings and grow both earnings and cash flow. And in order to do that, you want businesses that are in growth industries. Clearly, if a business is able to gain market share, that's like the cherry on top. But you want a business that can sustain high growth rates at, say, above GDP growth of the economy over time, so that as shareholders, we can benefit with that growth and stay invested over long periods of time. And lastly, another core tenet is we like to stay invested along with capable management teams. So we spend a lot of time interacting with management and trying to understand what their key drivers are. Also, we look into their proxy statements to understand what their incentives are, just to make sure as minority shareholders, our interests are protected and we are invested, with a business manager that has a history or a track record of allocating capital and sustaining that competitive advantage over time. So, being long-term investors, I think investing along with capable management teams is extremely important.
Yeah, that's a really interesting way to think about investing as a framework. When you look back at your career and all the different market cycles that you've observed and invested throughout, is there an experience that sort of shaped this framework and how you think about investing overall and maybe adjusted the way you look at markets?
Yeah, over that period, of course, the market has had many periods of strong returns as well as drawdowns. But the one period that really stands out through my investment career is the global financial crisis in 2007 or late 2007 and '08 and '09. And I think the way that has framed my outlook on investing is, if something appears too good to be true, it probably is. So, if you look at a business that's been growing at a tremendous pace and the management is very gung-ho about what's going on, I think you need to step back and take the time to really understand what the business exposures are, what the potential downside is. When things are going well, as many investors say, all the boats can rise, but it's when the water goes out, a key phenomenon or key philosophy of Warren Buffett is, when the water goes out, we know who's swimming naked. And so it's really important to understand the downside. And the way we incorporate that in our investment philosophy is, before we initiate a position in any company, as much as we are focused on the upside, we do spend a lot of time thinking through the downside and trying to make sure that our capital is protected if things don't go too well. A lot of the value managers like to say or look at businesses on a price to book basis. And they say, something trading at 1 times price to book with a decent ROE, it looks like a very attractive business. But, they fail to recognize that book value can be impaired by events in the marketplace. And that's what we saw in 2008 and 2009. All these banks and financial institutions that were sitting on these various products that ultimately were exposed to the mortgage market. When things went down, they had to take huge impairments. A lot of the businesses at the time didn't survive. So to say that, a business is trading at or around book value, it does give you some level of comfort, but you need to really look deep into what is in that book value to understand, what the downside could be. So again, to sum it up, I mean, we are very conscious of the downside, and events like that, help you understand what the, downside could be. And you want to make sure that you're not exposing your investors to that level of downside through the investments you're making in the fund.
Yeah. And I think it's a really important point, especially in times like now, where these AI narratives have just gone rampant throughout many different sectors in the economy and in markets. And just we're kind of realizing that just because something is valued at a level we deem, or the market deems, as expensive or cheap, that doesn't actually make the business model insulated from these types of risks and new technologies. So it's, I think, really important that you on the team are doing that work and looking at what actually makes these businesses tick and generate cash flow going forward. I guess sure. It's a pretty good segue into maybe the fund specifically. And what do you see as the objective when you're managing the portfolio of the U.S. small mid-cap fund?
I think the key objective, as most fund managers would say, is to outperform the market over long periods of time with the protection on the downside. And, we don't just say that as a statement, we actually live by that. And one of the things, as I just said, was being aware of what the downside is for every position that we have in the portfolio. In addition to that, we do look for quality companies, which, as I defined, is companies with a sustainable competitive advantage that are able to earn a return on capital above their cost of capital. But it also means we are investing in companies with a strong balance sheet, a growing and strong cash flow position. So when things turn down, at least their business is not exposed to balance sheet stress. So, you could have a period where the business doesn't do that well, but as long as they have a strong balance sheet, that they will survive the downturn. And that really is very important for long-term investors, because, you could do exceptionally well in one or two positions, but if even one or two of your holdings, end up going bankrupt or, losing a lot of money, you could spoil the returns for the investor. So we are very aware of the downside, and we try to manage that both through diversification in the portfolio, as well as making sure that we truly understand the downside for every stock in the portfolio. So, as long as we do those two things, we're protecting the downside. And at the same time, by investing in growth businesses with capable management teams and which are able to earn a return above their cost of capital, I think we're able to compound earnings over time. And a combination of those two we believe over time will help us outperform the market and protect our capital on the downside.
All right. So when we talked more recently on just celebrating the 1-year anniversary of this fund, what I found pretty interesting, given, I guess, Pender's traditionally been predominantly investing in Canada and a little bit of US exposure, but this US small mid-cap space just seems really interesting and a lot of opportunities. What do you think investors are missing or not looking at deep enough when it comes to your investable universe?
Yeah, so for Canadian investors, I think the US market offers the opportunity to gain exposure to a number of sectors that are not as well represented here in Canada, especially in the small mid-cap space. Everyone talks about AI as a theme that will play out over the next several years. But in the small mid-cap space, you have industrial companies that are benefiting from exposure to the infrastructure required in order to implement those AI models, or be it like investments that are happening in the data center or investments in the backup power or power generation needed to run those data centers, as well as various other businesses, including the chip manufacturing and chip supply. We have some exposure through the memory market as well. So there's a lot of businesses that play into that AI theme that investors in Canada maybe don't have the same level of exposure. Another area where Canada is underrepresented, I believe, is in the healthcare space. So there's been a lot of excitement around the GLP-1 drugs that I'm sure you're aware of. And, the key players there, of course, are Novo Nordisk and Eli Lilly, which are too big for the small mid-cap space. But we do have companies that have exposure to that theme, either in terms of packaging or various other support functions to those big drivers for the pharmaceutical industry in the US. And again, it's hard to get those exposures here in Canada. So I think, gaining some exposure to the US through this fund is a great opportunity. The other thing I want to point out is there's a lot of investors in Canada, I'm sure, who've participated in the large cap marketplace in the US through the Mag 7 or other large players, either through active ownership of those stocks or through passive indexes. And we've seen, those stocks do really well. And now they're almost 40% of the S&P 500 and maybe a bigger share of the NASDAQ. So I think a lot of investors are kind of concerned from what we've heard from our investors. One, by the volatility they've seen so far, as well as the fact that, these indexes or these businesses have done so well over the last several years. And now, having done well, they're concerned that maybe they're due for a pullback, or maybe they don't get the same level of returns for the next several years. On the other hand, the small mid-cap space, if you look at the market as a whole, which we feel is represented by the S&P 400 index, mid-cap index. You look at it on a relative valuation basis, it's cheaper than the large cap space, as well as we're seeing after 2 or 3 years of below trend growth, we're seeing earnings growth come back to the small mid-cap space, in part due to exposure to some of these themes that we talked about. So I think it's a great setup for investors to gain exposure to the small mid-cap space. Both for the fact that valuations are reasonable, as well as we're seeing earnings growth and cash flow growth really kick in here over the next 12 to 24 months.
Yeah, no, I think you made a really interesting point about just that emphasis on the Mag 7 and these few mega cap names just taking up so much of the market narrative in the US. It's also something we just don't see in Canada. We don't have those dominant forces in the same way. But like you said, those have just had such exceptional momentum that there's so many names that are underfollowed and misunderstood. And often, even when I hear about you telling us in investment team meetings, like, I didn't know that company existed, because there's just so much opportunity investing in the US of doing these businesses, doing things that are critical, like in healthcare, but aren't necessarily coming up on the Globe and Mail on a frequent basis. So I think it's pretty interesting that your team is able to dive into these unique stories that advisors or other investors maybe aren't looking at quite as much.
Yeah, for sure.
Yeah. So maybe I wanted to circle back on that valuation gap between the small and large cap names. It seems like there's been a narrative for a while now that this gap has to close and that it's been getting wider and wider. And it's almost sounds a bit like a broken record at points, but now it does seem, even in Q1 of 2026, we have seen the beginnings of that tide turning and more interest in small cap. How do you think about the valuation mismatch going forward and what could close the gap?
Yeah, so if you look at it on a forward PE basis, the small mid-cap space is trading at about 16 times forward earnings right now and a cash flow yield of about 4%, whereas the large cap space is trading at, like going by the S&P 500, is trading at a PE multiple on a forward basis at 20 times and only a cash flow yield of about 2.5%. So we believe clearly, like you said, the valuation gap exists. And I think the time has come for that gap to narrow now, because we've had a period of almost 5 years in a row that the small mid-cap space has underperformed the large cap space. And, some of that may have been valid for the last several years because the large cap, especially those Mag 7 companies, were posting 35-40% annualized growth in earnings. And at a time when the small mid-cap stocks were somewhat struggling, were not growing earnings at the same level, partly because coming out of COVID, when we saw a big increase in their profit margins. So they had that high base and they were kind of working through that, and the profit margins were normalizing. But I think we've reached a point where, again, profit growth is kicking in that small mid-cap space. And I do believe that for the next 2 or 3 years, or maybe even longer, the profit growth in the small mid-cap space is going to outperform the large cap companies, just because, one, they've become so big. If you look at companies like NVIDIA and the scale they're at, the law of large numbers basically means that, for a company with that kind of revenue and market cap, you cannot continue to grow at 35-40%. So growth rates for those large caps is going to slow down. But at the same time, we're seeing those companies continue to invest in things like, just as an example, in things like data centers to run the AI narrative. And, it's the small mid-cap industrial companies that are serving that market. So we see that as a good growth opportunity for the small mid-cap space. And I think the market has somewhat begun to catch on to that theme. And like you said, we've seen small mid-cap space outperform the large caps. And I believe that will continue for the next several years.
Yeah, no, I agree with you. And something that I've been sort of thinking about as well is when we're seeing these massive CapEx numbers coming out of the Mag 7, I think I saw a stat where, as a percentage of GDP, from a percentage of GDP perspective, the AI investment is actually more than what the North America spent building the Intercontinental Railroad system, which is almost a baffling amount. And we're really have yet to see the ROI in these massive CapEx numbers. And historically, the Mag 7, especially a couple, have been so capital light, and that's driven a lot of their revenue numbers. Now the math's changing quite a bit, and I'm not sure that the market's fully grasping that the profitability isn't going to be necessarily what it used to be. So it does offer this opportunity as you go down cap, and it seems like that itself will continue to become more and more prevalent. So when there's so much going on, whether it comes to AI or geopolitical risk, how do you think about finding new ideas for the fund, and where sort of your hunting grounds when you're trying to think through opportunities going forward?
I think one of the benefits of a clearly defined investment process is it helps us narrow down the universe. So if you look at the small mid-cap space, there's about 9,000 companies in the US. And you'll be surprised to know, actually, the small mid-cap space in the US is larger than the entire Canadian marketplace. So that's a huge fishing pond to choose
Yeah.
from. But what we do is, one, use screening tools to narrow it down to companies that earn a return above their cost of capital, as I've said in the past, and companies with a strong balance sheet. So that narrows down the pool to a more manageable number. And then, either through looking at those businesses and looking at the fundamentals, or attending conferences, or talking to analysts, or just, generally reading about what's happening in the business world, we come up with new ideas. And then the analysts that I work with, Ruben and me, we sit down, we, go deep into the financials of those businesses, talk to management, talk to some of their suppliers or some of their customers. And it's only when we're very comfortable with the business, we see an attractive upside, as well as we are confident that the downside is manageable and we are protected in one way or the other. It's only then that we decide to make the investment. So I think we have a very thorough research process, and it gives us the confidence, that we'll be able to manage the portfolio well and be able to outperform over time. And one of the hallmarks of that process is, before we invest in a company, we do very detailed modeling, where we try to look at what the earnings and cash flow profile would be for the next 10 years. And then using a DCF model, which is a discounted cash flow model, we try to arrive at the intrinsic value of the business, which is not exactly a point estimate. It is a range that can vary between the bull case, which is if everything goes well, and the bear case, where things don't go as well as we would expect. And then using probabilistic weights on those two scenarios, or those three scenarios, we arrive at what we believe is the weighted intrinsic value. And only when we see at least 20 to 25% upside in a stock, that would we invest in a new business.
Yeah. Now that makes a lot of sense. And I like that you keep coming back to this idea because of the mitigating that downside risk. Because often when investors hear about small and mid caps, it's the first thing that comes to mind is risk. And then secondly, volatility. And knowing that you have a process in place to mitigate the downside is really important. When you're thinking about maybe that's the second side of the coin of volatility, how does that play into your process and when you're evaluating both current names as well as potentially new names in the portfolio?
Yeah, so one, we have about between 25 to 35 positions in the portfolio, and we are aware of what their exposures are. So we consciously make the case that we're not exposed to the same theme or the same key variables across the portfolio. We want to make sure, again, that if things don't go well, a certain number of businesses that we own will still manage to perform, because maybe they have leverage to a down cycle in the economy. So maybe defensives like healthcare would protect us on the downside, whereas some technology names or some industrial names would help us, outperform in a rising cycle when the economy is doing well, because they have exposure to the upside. So we are very conscious of those exposures, as well as you said, we are very conscious of the downside. And, when we weight the positions in the portfolio, we also think about risk in the sense that it's not only the volatility in the stock price, but more importantly, the risk of the business. So if we invest in a business that has a history of profitability, history of growing earnings and cash flow, where we believe the management team is very capable and they've been able to allocate capital judiciously, we'll maybe take a higher position, even if the upside doesn't warrant that higher weight in the portfolio. On the flip side, if we see a business that's been very volatile or that has exposure to parts of the economy that can be volatile, even if it offers an attractive return to intrinsic, we might take a slightly lower weight in the portfolio, just because, and again, it's not the stock price risk we are worried about, because we see volatility as an opportunity, but it's the business risk that we try to work around and make sure that if we are taking a certain position, we are being compensated for it.
Yeah, no, I really like that point of that we're not trying to manage stock price risk. It's fundamentally the businesses that you're looking at. Because I think that does come down to our core of being bottom-up investors. And I think that's something that has gotten lost in a lot of the narratives in markets today, is just because a company does move violently one direction or the other doesn't mean there's been a lot of change in the fundamental businesses. And like you said, it is pretty exciting when, although you don't like to see your names trade down dramatically, it does offer this really unique opportunity for active investors who understand businesses to be able to take positions that they have high conviction in, especially in a concentrated portfolio like you said you have. When we talk about concentration, is the sort of number you have currently, the 25 to 35? That's kind of the long run size of the portfolio. Like, how do you think about keeping the number of names smaller?
Yeah, we think about our positions in a range of between 3 to 5%, ideally. So when you work around that, it basically means you either own 25 to 35 businesses or somewhere around there. And that's how we think about the number of businesses and the exposure we have. And again, as much as we want to be invested in the most exciting business, we are aware of and cognizant of the risk. So any stock or any business that makes it in the top 10, we follow it like a hawk. We see everything that's going on, and just because of the impact it could have on the portfolio, we are very closely monitoring what's going on in the top 15, 20 names. And that's not to say that we ignore the rest of the portfolio names, but we do really concentrate our time on the top names that we own. And then that could be, we try to take advantage of the volatility that you talked about in the marketplace. So if we see an attractive business that for whatever reason the stock price has been volatile and it drops, as long as we are comfortable with the fundamentals, we would take advantage of that volatility, either on the downside or on the upside. So we do trade on the edges. I mean, we maintain our core positions, but when we think it's overvalued or doesn't offer the same attractive returns potential, we would not hesitate to trim it. And at the same time, if something drops and we feel fundamentally that drop is not reflected then or not required, then we are happy to increase our position. So we do maintain a long-term investor thinking, but we like to at the same time take advantage of market volatility to maximize our returns.
Yeah, no, that's another advantage of being an active manager, is being able to be nimble in that way and have a real strong following on those core names. When you do face those drawdowns and seeing core positions sell off, what sort of things are you and the team trying to evaluate when it comes to determining if this is a temporary valuation dislocation versus it being truly a broken thesis where you'll have to rethink the company overall or as an investment?
Yeah, again, there having a very well-defined investment process comes to the rescue. Every time we initiate a position in the fund, we always write a 1 or 2 pager on the thesis. So be very clear about why we like the business, why we want to own the business, and what needs to happen for us to continue to own the business. So anytime there's a dislocation in the marketplace, we go back to the initial thesis and just evaluate whether that thesis is still valid or not. And if for some reason the thesis is broken, we are happy to take our money and move on to something else. But again, having defined the thesis right at the onset helps us in the sense that if we had not done that, and if the stock were to drop, we wouldn't know how to react, partly because we didn't know what we were kind of searching for or what we are solving for. But in the case where we have documented what the thesis is, it's very simple to compare the market narrative versus our initial thesis or the revised thesis that we might have done over time to make sure that we still like the business. And if we do, we are happy to use that volatility to maybe even increase our position.
Yeah, no, it's an important part, because when you're covering hundreds of names or looking at a much broader universe on a consistent basis, it would be very hard to maintain that amount of up-to-date theses. And I think that's where some investors get in trouble, is being reactionary rather than how your process is planning for the worst case scenario in advance and making sure that you don't have to get caught off guard if Anthropic announces a new model. It's just within the way you're evaluating companies every step of the way. When we look at, I guess, the broader universe now, where are you seeing exciting opportunities in the US small and mid cap space? I know we briefly touched on AI and healthcare, but maybe what parts of that do you find interesting, and what is the team really excited about as we go further into 2026?
Yeah, in addition to the AI and healthcare themes that we talked about earlier, I think another area that we are seeing a lot of opportunities and we are seeing that growth tailwind is in the aerospace and defense marketplace. Coming out of COVID, the two behemoths in that business, Airbus and Boeing, their production was significantly impacted by the supply chains not being able to keep up with demand and being disrupted, especially in Asia. What we've seen since then is gradually there have been some changes in management. There's been other changes that have taken place. But over time, they have now, just about now, begin to get their house in order again, and they're beginning to ramp up production. If you look at the forecast for both Airbus and Boeing, they're talking about 10 to 15% growth in deliveries in 2026. And I think that kind of growth can be sustained because they're sitting on a big backlog for commercial orders. So I think that growth is there. Another thing that is worth keeping in mind is they had decent growth in 2025 in terms of deliveries, but some part of that came from the fact that they were sitting on inventory of semi-finished goods, which are missing one or two parts. So, a lot of that supply came from the fact that they already had semi-finished goods in their inventory. When we are looking at 2026 and beyond, most of this is new products that are being manufactured, new planes that are being manufactured. So companies like, we own Hexcel, which is a supplier to both Boeing and Airbus. And so companies that are in the supply chain to these two companies are gradually beginning to see a ramp up in demand. And I think, again, we have a long tail of that growth ahead of us. And all these aerospace suppliers to the OEMs will benefit. We are also seeing a tremendous amount of growth in flying hours around the world. Most airlines are saying, in spite of the recent disruption with increase in oil prices, we are still seeing very healthy booking trends. Most of the US airlines, including Delta, said that they've not seen any major or noticeable impact on bookings so far, at least. And I think that probably points to the fact that people are looking forward to travel, both in terms of business, now that business is picking up and people want to go and meet their clients, but also in terms of leisure travel. And increasingly, we're seeing the leisure traveler is willing to pay that extra premium and go in business class or upgrade their seats in order to make that journey a little more comfortable. So I think one of the beneficiaries of that is airlines, but at the same time, as I said, it's the suppliers into these airlines. And thirdly, it is the MRO company, which is basically maintenance and repair companies that are maintaining those aircraft. So the more those aircraft fly, the more you need to take them into the body shop and make sure that all the parts and everything is in order. And this is by regulation that after a certain number of flying hours, those airplanes have to go into the body shop. So we do own some MRO as well, which is benefiting from both commercial airline growth, but also growth in the defense side. And increasingly, we're seeing increase in demand on the defense side as well.
Yeah, it's one of my favorite parts of when I get to speak with you and the team is you in the US can talk about these big trends like what Google's investing in AI or what these massive airline companies with their flight patterns look like. But because those are such large cap names, it's actually the second order effects in these companies that a lot of us have never heard of. And those are the opportunities you're investing in. It's so interesting. Like before working at Pender, I didn't know what an MRO was. And then by seeing how this is this opportunity within aerospace and seeing you look into these unique sectors, it's quite interesting and pretty unique as an investable universe for sure. Okay. How we have like okay. When you look at the fund, I know it's only been about a year, but is there a current or past position that best represents what the fund is trying to achieve when you look at the performance so far?
I like all the stocks we own, but one company that I can point to that I think reflects what we look for is Dollar Tree. So if you look at the history of the business, it's been a compounder. It's done phenomenally well over the last decade or 2 decades. But it had a bit of a misstep when they bought Family Dollar store a few years back, and that disrupted their business. And they came to realize that the Family Dollar business and the dollar store were not really compatible. Family Dollar was more rural, and they had a slightly different clientele. And it took a few years for them to realize that they had to sell it at a loss and book the write down on the Family Dollar store. So we initiated a position at the end of 2024, which is when the fund was launched. And that was the point of peak pessimism on the story. But since then, we've seen the stock rebound, partly because one, they've freed up management's time to now focus on the Dollar Tree banner since the Family Dollar is not there anymore. Secondly, we've seen, historically, whenever there's inflation or the low-end consumer is a little stressed, they tend to gravitate towards these cheaper banners like Dollar Tree. And we're also seeing some of the medium to high income households trade in or trade down into Dollar Tree, and therefore their TAM, in a sense, is expanding with now that they're able to address the needs of middle to high income households. And another reason they're able to address that need is that they've gone from selling products only under $1 to now, first they broke the buck, as they call it, in 2022 when they started offering products at over $1. But more recently, about just over a year back, they also introduced a multi-price point where they're able to offer products between $3 to $5 range. So even now in the most recent quarter, the average ticket price for their products was about $1.35. So they're still very reasonably priced, but they do offer those slightly higher priced items to households that are looking for slightly better products or slightly different kind of products that the Dollar Tree was not able to offer in the past. So I think, again, this is a business that has a history of doing well, was in the short term impacted by events, and we took benefit of that opportunity to initiate a position. And since then, it's done well. More recently, the stock has come under a bit of a selling pressure because people believe that consumer spending will be constrained, which probably might turn out to be true. But I think the market or the stock has overreacted to what might be a quarter or two of slower growth in their sales. But I think we continue to like the business, and we see it as a core holding that continues to grow its sales and add new stores in the US.
Yeah, no, I think that story is really interesting. And it's good to see, too, something that you had conviction almost like 2024 is still today a core position, and that one that regardless of the economy changing and geopolitical risks changing, you still believe fundamentally in the business. And that definitely circles back to all the themes that you've already touched on today about your process. Maybe just zooming out, more fun question before we wrap up. Let's say we are time travelers and we fast forward 5 years. What do you think investors may have misunderstood about the moment we're at today?
I think people who've not participated in the small mid-cap space kind of are ignoring a very important part of the marketplace, partly because they think these are smaller companies, in some cases unprofitable. Their management team has not been tested. And so they stay away from those businesses, especially, their view of these smaller companies are, one product, some small market, and they're growing at 2 to 3%. But when you dig in, you would be surprised to see some of these businesses have been around for a long, long time, have sales and earnings that are unmatched in terms of their growth historically, as well as the fact that they're highly profitable, high return on capital, and because they are still relatively small, they offer multi years of growth ahead of them. So I think 5 years down the line, when people look back at this time, especially given, like we talked about, the valuation gap between the large cap and the small mid cap space, I think people would say that the exposure they had in the small mid cap space, and hopefully our clients that are listening have some exposure or are looking to add exposure, they'll say that, really paid rich dividends over the last or the 5 years since 2026, because earnings growth, like I said, is expected to be very strong. And these are businesses that have been ignored and are trading at very attractive valuations right now. And I think our investors should be well advised to gain some exposure to this part of the marketplace.
Yeah, no, I hope that our prediction is true. And I hope that in 5 years' time, we finally get to the point where numbers do outweigh narratives when it comes to stock price valuations and how companies are looked at from an investor perspective. So it'll definitely be an interesting few years going forward. Our final question is one that we ask all of our guests on the podcast, and that would be, what's one book that's influenced how you think about investing?
I tend to read quite a few investment books, but I think the one that, and it's not one book, but it's several pieces of advice that I've gained over the years by reading Warren Buffett's letters to shareholders, as well as several books that have been published about his investment philosophy. I think that's really helped me frame my own investment framework, even though clearly there are some differences from the way he thinks about investments. But I think the core tenets are fairly similar. And the one thing I always go back to that he said is that you make money by not timing the market, but by time in the market. So as long-term investors, we like to think of ourselves as in it for the long term. And we encourage our investors to similarly, stay invested in the fund for the long term and reap dividends over time. So hopefully, some of our learnings that we've implemented in the fund can benefit some of our shareholders, like investors in Berkshire Hathaway have benefited over the years by compounding their wealth. Hopefully, we are able to compound wealth for our investors over time.
Yeah, no, that's great. It also reminds me of one of our other favorite Buffett quotes, is the idea of being greedy when others are fearful and fearful when others are greedy. And I think that's a pretty prominent aspect of both how you're positioning in the market today and what we've seen over the last several years of this rise of passive and the mega cap names dominating, but then this really interesting opportunity in the underfollowed and misunderstood small and mid cap space. So hopefully we can all take a page out of Buffett's book and see the turnaround in the fundamental value long-term investor as we move forward. Well, yeah, Aman, thank you so much. This has been a really interesting conversation. Thanks so much for the time for talking about the fund with us today. I know I definitely learned a lot.
Thank you very much, Laura. It was a pleasure, and hope we can do this again. Thank you.
Yeah, for sure. Well, we'll be back soon with more discussions on opportunity, risk, and the ideas shaping the Pender Fund portfolios. In the meantime, you can follow our ongoing commentary on Substack at the Pender Pulse, which is where we're sharing what we're seeing, debating, and learning about in real time, as well as our management commentary and other podcasts on our website. Thank you so much for listening, and stay tuned.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at penderfund.com.